Welcome back to the Deep Dive. If you are operating in the world of real estate and investing today, well, you know the environment is incredibly complex.
Oh, absolutely.
Interest rates are up, down, sideways.
Yeah.
Technology platforms emerge seemingly overnight, and just cutting through the relentless wave of information to find actual actionable truth is exhausting.
It absolutely is relentless. And, when the market environment is constantly transforming like this, maybe the most valuable thing you can do is stop chasing the ephemeral trends
Right.
and ground yourself deeply in the foundational principles that simply do not change.
Okay.
That's really our mission today, to move past the noise and deeply analyze the time-tested financial, operational, and even psychological concepts governing real estate and investing. We've synthesized this directly from a diverse stack of, reliable sources.
Okay, let's unpack this then. We'll try to ignore the fleeting market predictions for a bit and ground ourselves in those essential concepts, the ones that underpin the entire market, really, regardless of, say, technological shifts. So we start where all serious investing starts. Establishing the core financial bedrock.
Right. And when we look at foundational investment theory, especially maybe in the stock market where the data is just so abundant, our sources consistently point to these fascinating psychological biases. They really reveal where success lies, and often, it's not with the crowd.
That immediately brings up one of the most intriguing concepts in behavioral finance.
Yeah.
The odd lot theory.
Yes.
It's essentially this, cynical belief that successful investing is achieved by doing the exact opposite of what the amateur investor is doing.
Exactly. The odd lotters, as they're called, are traditionally defined as people who trade stocks in batches smaller than 100 shares.
Okay.
These small, sort of non-standard transactions, historically, they were performed by the smaller, often less informed individual, the amateur.
Right, the little guy.
Yeah. And the theory holds that these investors are consistently late to market cycles. They get overly enthusiastic near the peak and then overly pessimistic near the bottom, the trough. So therefore, the successful strategy is supposed to be buying when the odd lotters are selling in panic.
Right.
And selling when they're enthusiastically buying at the top.
What's truly insightful about this isn't just the mechanism, but the psychology behind it. It seems to endure because these retail investors are often driven by, recency bias and herd mentality.
Totally.
Which causes them to make emotional rather than, analytical decisions. You have to actively fight that instinct.
Precisely. And related to fighting instinct, there's another consistent finding about the performance of different stock types.
Okay.
We often hear about chasing those high-flying growth stocks, the companies with explosive potential, but often pretty poor current cash flow.
Yeah, the sexy names.
Right. But the actual historical data favors a different, maybe less glamorous approach. Value investing.
Value stocks. So companies that look cheap based on their underlying assets, they've consistently outperformed.
That's what the data suggests, yes. To measure this, analysts often use what is called the HML value factor.
HML.
Yeah, HML, it stands for high minus low. It's actually a core component of the FAMA French three-factor model.
Okay.
It essentially provides a metric for the premium you earn for taking on the quote-unquote risk of buying these value companies. It measures the return difference between the 30% of stocks selling at the highest multiples of book value compared to the 30% selling at the lowest multiples.
Now, for those maybe unfamiliar with the terminology, why does book value, which is largely like an accounting snapshot of historical costs, why does that remain such a robust metric for predicting future returns, especially with all the sophisticated financial modeling we have today?
Well, it speaks to market efficiency or maybe the lack thereof. Book value is an inherently conservative, tangible metric. When stocks trade far below their book value, it often suggests this deep, market-wide pessimism. Pessimism that's maybe disproportionate to the actual assets the company holds. So investors willing to stomach that risk, that temporary pessimism, they tend to be rewarded.
And the data backs this up.
Oh, yeah. The data confirms this. From 1927 all the way through 2017, this HML value factor produced a pretty staggering annual risk premium of 4.9%.
Wow, 4.9% annually just for tilting towards value? And the risk-reward profile of that premium is just as important, right?
Absolutely. We quantify that with something called the Sharpe ratio.
Right. Return versus risk.
Exactly. It's a measure of investment performance that accounts for risk for volatility. The Sharpe ratio for this HML value factor stood at 0.34 over that period.
So 0.34. How good is that?
Well, to put that in context, any Sharpe ratios significantly above zero suggests that the investment is generating meaningful returns in excess of the risk-free rate relative to the volatility it introduces.
Okay.
So a 0.34 for a persistent factor like this demonstrates a sizable and pretty enduring reward-to-risk ratio. It really validates the strategy of seeking intrinsic value.
Speaking of time-tested strategies that require discipline, nothing really underscores the power of consistency in a volatile world better than dollar-cost averaging, or DCA.
Ah, yes, DCA.
Our sources give a fantastic, almost counterintuitive example of why market dips can actually be your financial friend.
This illustration, it fundamentally challenges our emotional desire for markets to just always go up, up, up.
Right. We hate seeing red.
We do. So we're comparing two 5-year investment periods. In both, you invest $1,000 annually, so a total investment of $5,000.
Okay, same money in.
Same money in.
Got it.
In the first scenario, let's call it the roller coaster market. The value of your portfolio falls, then rises sharply, falls again, and ultimately after 5 years, the market finishes exactly where it started. Zero net change.
Flat overall.
Flat overall.
Right.
In the second scenario, the dream market, the price rises continuously and ends up 40% higher than where it began.
Much better, obviously.
You'd think.
Yeah.
If you ask any investor which scenario wins, they will overwhelmingly choose the continuously rising market. But the math surprises you. In the volatile zero-return market, the investor ends up with a final stake of $6,048.
More than they put in, even though the market was flat.
Exactly. Now, in the continuously rising market that finished 40% higher, the investor's final stake is only $5,915.
Wow. So you actually ended up with less money in the market that went up 40%.
That's right.
So you generated a higher total dollar return in a market that saw zero overall appreciation.
How?
Simply because you adhered to the schedule. You kept buying.
Yeah.
And you purchased more shares, more assets, when the prices were severely depressed during those dips.
It forces you to buy low.
It's the ultimate argument for disciplined execution. The success of DCA isn't about timing the market, predicting the bottom. It's about maximizing the purchase of assets during times of fear. The moment the market feels terrible.
Yeah.
That is precisely when your consistent investment schedule is most effective. It forces you to acquire assets cheaply. That foundation of consistency and value preference needs to pivot seamlessly to real estate now.
When analyzing a tangible asset, like a building, what is the core metric that defines its performance?
In real estate, we immediately focus on net operating income, or NOI.
NOI.
This is the annual property income after you subtract the costs of property operation. So things like rent loss due to vacancy, management fees, utilities, repairs.
Got it.
But crucially, NOI is calculated before accounting for debt service, your mortgage payment, and before capital expenditures, or CapEx, and income taxes.
Okay, before debt, CapEx, and taxes. And for experienced investors, understanding the common calculation pitfalls is vital. We know what NOI is, but where do people most often make mistakes when calculating it, especially, when they're underwriting a deal?
The biggest mistake, honestly, is blurring the lines between operating expenses and capital expenditures.
Ah, okay.
Operating expenses are necessary routine costs like minor repairs, landscaping, management fees.
The day-to-day stuff. Exactly. CapEx involves major replacements or improvements, a new roof, a new HVAC system, repaving the parking lot. Those are not included in NOI.
Right.
Failing to properly budget for recurring CapEx down the line, and accidentally treating it as just another operating expense that inflates the apparent NOI.
And leads to overpaying for the property.
Precisely. You think it's performing better than it really is.
That's why investors often rely on quick cash flow estimation rules, like the 50% rule, especially when initially screening potential deals.
Exactly. The 50% rule is a simple heuristic, a rule of thumb.
Yeah.
It states that operating expenses, again, excluding the mortgage payment, the P&I tend to approximate about 50% of the gross rental income.
Okay.
So if a property generates, say, $2,000 in monthly rent, you quickly assume $1,000 in expenses. Then you see if the remaining $1,000 can cover the mortgage and still generate profit.
It's a fast screening tool, though, not a final valuation method.
Definitely not. Just a quick check for feasibility.
Now, when we talk about how real estate builds wealth, the single greatest multiplier, the engine that turns slow accumulation into potentially rapid acceleration, is the strategic use of leverage.
Debt. Leverage, yes. It's a powerful wealth accelerator, but, and this is a huge but, we must emphasize that it inherently adds risk.
Right. Always.
The investor must carefully assess their personal risk tolerance against the required debt service, the mortgage payments. Let's make the math Maybe a bit more sophisticated than just the initial example in the outline.
Okay, let's assume an investor, Sarah, has $200,000 cash.
Okay. Scenario A. Sarah buys one $200,000 property, all cash. Let's say it yields $1,500 monthly NOI.
So $18,000 a year.
Right. Her cash-on-cash return before taxes is 9%. $18,000 NOI divided by her $200,000 cash invested. Simple, pretty safe, but kind of slow.
Okay, scenario B.
Scenario B. Sarah uses that same $200,000, but this time as a 20% down payment on 4 properties, each worth $250,000.
Whoa. Okay, so now she controls $1 million in real estate.
Right. But she also has $800,000 in debt, financed at, let's say, 7% interest for this example.
Okay.
This is where positive leverage can kick in. Even though she's paying 7% interest on the debt, if the properties themselves are generating an overall return before the debt that's higher than 7%, she profits significantly.
How does that look?
Suppose the total NOI across all 4 properties is $60,000 per year, and the annual debt service, the principal and interest payments on that $800 loan, is $52,000.
Okay.
Her net cash flow is $8,000 per year. $60K, $52K.
That's actually less cash flow than the all-cash scenario, $18K.
It is less immediate cash flow, yes. Only $8,000 versus $18,000. But she controls 4 times the asset. She benefits from 4 times the principal pay down on the loans.
Right, the tenants are paying down her debt.
Exactly. And potentially 4 times the appreciation. So her true return on investment, once you count appreciation potential and that principal reduction, is now potentially exponentially higher than the simple 9% she got going all cash. That's the power of using the bank's money to build scale.
That scale is the key benefit, for sure. But as you said, the risk is real.
Absolutely.
If the market shifts, rents drop slightly, vacancies go up, she could quickly move from positive cash flow to negative cash flow because her debt service, that $52,000, is fixed.
Absolutely. Leverage amplifies gains on the upside, no doubt.
Yeah.
But it accelerates losses just as fast on the downside. Professional investors manage this by maintaining robust cash reserves
Crucial.
and ensuring they only employ positive leverage where the asset return is comfortably exceeding the cost of the debt.
Good point. Okay, moving on to structure a bit, let's discuss 2 more advanced tools, REITs and specific tax strategies that only real estate really allows.
Okay. Real estate investment trusts, or REITs. These are unique investment vehicles. They provide liquidity, which is a big plus.
Yeah, you could buy and sell them like stocks.
Exactly. And diversification into large-scale commercial property office buildings, malls, data centers, stuff you couldn't buy on your own.
Right.
And by law, they must distribute at least 90% of their taxable income to shareholders as dividends.
Why is that important?
Well, it tends to align management interests pretty closely with shareholders because their success, their compensation often is tied to those distributions.
Makes sense.
Furthermore, their financial condition is generally highly transparent because they have strict SEC disclosure requirements. That sets them apart from many private real estate equity funds where transparency can be variable.
Okay, so REITs offer transparency, liquidity. But the truly transformative power of direct real estate ownership, owning the actual property, often lies in its ability to shield income, using a mechanism pretty unique to this asset class.
That mechanism is depreciation.
A magic word.
It really is, tax-wise. Real estate is considered a non-cash expense on your tax return. Basically, the IRS assumes the building itself is losing value over its lifespan, currently set at 27.5 years for residential property.
Even if it's appreciating in the real world.
Even if it's actually going up in value. Our sources give a powerful example. An investor might receive, say, $20,000 in actual cash income from a rental property in a year, cold hard cash in their pocket. But after applying the allowed depreciation deductions on their tax return, the taxable income might only be $1,950.
Wow. That's a huge difference. So you receive 100% of the cash flow, the $20,000, but you only pay income taxes on about 10% of it, the $1,950.
Correct. The cash flow is effectively sheltered from taxes, often for decades, until the property is eventually sold.
Right, then you have recapture, but still.
But still, it makes the cash-on-cash return calculation significantly more powerful on an after-tax basis than almost any other asset class.
Okay. And for investors who have already generated large capital gains from other investments, maybe selling stocks or a business or even crypto, there's another powerful tool for deferring those taxes, opportunity zone funds.
Ah, opportunity zones, yes. These funds allow investors to defer capital gains taxes by reinvesting those gains into qualifying funds. These funds are aimed at developing economically distressed areas designated as opportunity zones.
Right.
But this isn't just a simple deferral. It can be a profound tax arbitrage if it works out. First, the original capital gains tax you owed is deferred until 2026. That's nice, but not the main event.
What's the main event?
Second, and most importantly, if you hold that opportunity zone investment for over 10 years,
10 years, okay.
the appreciation related to that opportunity zone fund investment itself may be entirely tax-free forever.
Whoa, so defer the original gain and then potentially get tax-free growth on the new investment?
Potentially, yes. It acts like a powerful tax arbitrage mechanism, leveraging the tax code to achieve future tax-free growth. But, and it's a big but for our audience.
Here comes the catch.
The catch, we have to address the major downsides.
Okay.
Illiquidity and execution risk.
You're locked in for a decade.
You are locked in for 10 years minimum to get that big tax benefit. And these funds must substantially improve or develop new property in the designated zones. They can't just buy and hold existing stabilized assets.
So construction risk, development risk.
Exactly. This introduces significant execution risk over a very long time horizon. Your due diligence, therefore, must focus intensely on the fund sponsor's track record.
What should you look for?
Things like their historical ability to actually execute large-scale construction or redevelopment projects, their capital deployment efficiency, can they actually get the money working within the required timeframes? This isn't passive index investing. It requires deep domain expertise in development. Okay, so shifting gears from the pure financials. While the stock market is highly efficient, mostly, meaning you pretty much have to transact at the current market value.
Right, you can't just call up Apple and offer 10% less for their stock.
Exactly. The real estate world offers a fundamentally different and frankly less efficient opportunity right from the start, at the point of purchase.
That's the core difference, isn't it? Real estate allows investors to potentially generate profit through the purchasing strategy itself, something that's basically impossible in liquid markets like stocks.
That's right. Unlike stocks, real estate allows transactions significantly below perceived market value literally every single day.
The trick, of course, is finding those deals, the off-market ones.
It is. You have to target motivated sellers. People who, for various reasons, divorce, death, relocation, financial distress, need to sell quickly and maybe bypass the traditional brokerage system.
How do you find them?
Well, it can involve extensive direct mail marketing campaigns, networking, driving for dollars, or focusing specifically on distressed properties like foreclosures.
Foreclosures sound like guaranteed profit sometimes, but they seem incredibly challenging for anyone unprepared.
They are. Foreclosure sales, like at the courthouse steps, typically represent losses for the lenders and the previous owners. But yes, they can offer substantial profit opportunities for the savvy investor. But they demand speed, cash, and often require the bidder to purchase the property sight unseen or with very limited inspection.
Oof, sight unseen.
Often. Yeah. And you might be inheriting existing title issues, liens, maybe even tenants you have to deal with.
So you need cash ready to go.
Usually non-contingent cash, yes. You have to be prepared to close very quickly. It makes this an arena only for the most prepared, well-capitalized professional.
Okay. So once a deal is maybe secured, the acquisition often requires creative financing solutions, especially if bank loans are tight or rates are high, things beyond a traditional 30-year fixed mortgage.
Absolutely. Two major alternatives really stand out in our sources. First, seller financing.
Where the seller acts like the bank.
Essentially, yes. This can appeal to sellers because, one, it might help them achieve a higher sales price than they could get from a cash buyer, and two, importantly, it allows them to potentially spread their capital gains tax liability over several years using installment sale rules.
Okay, benefits for the seller. What about the buyer?
It appeals to buyers who maybe have poor credit history, or maybe the property itself is unique or has issues that traditional banks won't touch. It really requires mutual trust and clearly aligned incentives in the loan documents.
Makes sense. And then there's the option for pure speed. When time is absolutely critical, the world of hard money lending.
Hard money. It's the rapid responder of real estate finance.
Sounds intense.
It can be. It offers very quick funding, sometimes in just a few days, with minimal paperwork and frequently no credit checks on the borrower. They focus almost purely on the asset, the property itself, as collateral.
Okay, speed is the advantage. the disadvantage.
It is extremely expensive. Hard money lenders often charge significant upfront points, like maybe 4% of the loan amount just to originate the loan.
Wow, 4 points.
And high interest rates, maybe 12% or even more. Plus, the loan terms are usually very short, like 6 to 18 months.
So this strategy absolutely requires a very clear and robust exit strategy.
Critically important. The inability to refinance that hard money loan into cheaper conventional debt or to sell the property profitably before that short loan term expires, that can be fatal to the deal, even wipe out your initial investment.
So what are the main exit strategies investors must vet before they even take out a hard money loan?
They must have a rock-solid plan, usually one of two. Either the refinance exit, meaning they are confident the property, after maybe some repairs or stabilization, will qualify for a conventional bank loan to pay off the hard money.
Okay.
Or the resale exit, a clear timeline, and a conservative valuation buffer to guarantee a profitable sale within that short, hard money time frame. Without a proven path out, hard money becomes a very high-stakes gamble.
Okay. Now, for those listeners participating more passively, perhaps investing in large commercial syndication deals put together by a sponsor, their job shifts, right? Yeah. It's less about hands-on acquisition and more about verifying the financial assumptions provided by that sponsor.
That is the core due diligence challenge for the passive investor in a syndication. Your primary job is ensuring the sponsor, the group putting the deal together, conducted a thorough investigation themselves, especially regarding their pro forma assumptions, their financial projections.
You need to be skeptical of projections that rely on, like, dramatic, unrealistic shifts in operational performance.
Exactly. We saw this illustrated vividly in one of the sources, a case study involving Tishman Speyer's acquisition of a massive portfolio of rent-stabilized apartments in New York City.
What happened there?
Well, the new owner, Tishman Speyer, presented a highly aggressive pro forma, their financial forecast, to bond rating agencies. They assumed a really rapid 15% turnover rate of the rent-stabilized apartments in the very first year.
15% turnover. Why was that important?
That turnover was critical because, under New York rules at the time, it allowed them to reset the rents on those turned over units closer to market rates, dramatically boosting income. Their plan relied heavily on this rapid turnover.
But the reality was less favorable.
Much less favorable. According to the source, the existing property management at the time informed the new executives that their projections were, frankly, completely unrealistic. They noted the actual historical turnover rate for those types of units was much closer to 4% or 5% per year.
Wow, 15% hope versus 4% reality. That's a huge gap.
It's enormous, and that gap underscores the danger of the hockey stick projection you often see in pro formas.
Right, where everything magically gets way better right after the sponsor takes over.
Exactly. So a passive investor must always demand historical performance data for the property, and frankly, treat any refusal by the sponsor to share comprehensive due diligence materials as a significant red flag. It might imply hidden risks or just wildly exaggerated forecasts.
Good advice. Okay, moving from acquisition and underwriting to actual operation. Let's talk about the critical process of preparing a property for sale home staging. This really feels like where psychology meets interior design.
It totally is. The guiding principle of home staging is simple. You must sell space and potential, not things or history.
Okay.
To allow a potential buyer to truly envision their own life in the home, you have to aggressively remove the seller's personality.
Get the current owner out of the picture mentally.
Exactly. That means packing up all personal mementos, family photos, kids' drawings on the fridge, any object that clearly defines the home as belonging to someone else right now.
And this extends beyond just personal stuff to general clutter, right? Especially on horizontal surfaces.
Absolutely critical. Every lateral surface needs to be uncluttered. Remove everything from mantelpieces, windowsills, desktops, and critically, kitchen counters.
Kitchen counters are magnets for clutter.
The biggest culprits. A clear surface subconsciously suggests more space, a cleaner environment, maybe even a less stressful life.
Interesting. What about aesthetics? Colors?
Aesthetically, staging favors neutral colors. Think beige, taupe, grige, tinted whites.
Why neutrals?
Because they are classic, enduring, and they provide a blank canvas for the buyer's imagination. They appeal to the widest audience. One tip from a source was to maybe avoid colder grays, which sometimes carry institutional or sterile connotations. You want warmth, but neutrality.
Okay. And the most sophisticated staging goes beyond just decluttering and neutral paint. It uses targeted vignettes.
Yes, vignettes. These are like strategic, maybe slightly romanticized snapshots tailored to the likely buyer demographic for that specific house or neighborhood.
Give me an example.
Okay, if the likely buyer is a young family, you might stage a sun-filled baby's room, maybe just a crib, a changing table, soft lighting, minimalist, neutral toys. Very aspirational.
No,
If the likely buyer is, say, a busy professional, you might stage a sleek, high-tech home office. Maybe just a nice desk, an ergonomic chair, a large monitor, perhaps some curated books on a shelf.
so you're helping them visualize a specific lifestyle.
Exactly. The goal is to help buyers dream about the life they could have in that home, rather than just inspecting the square footage and the condition of the appliances. It's emotional.
Right. Okay, so the house is sold or rented. Once the property is rented out, the focus shifts to tenant management. What are the key strategies here for mitigating landlord burnout and maintaining, smooth operational efficiency?
Landlord burnout is real, and it typically results from constantly dealing with high-maintenance, difficult, or even destructive tenants.
Yeah, nightmare tenants.
Right. So the strategy has to be proactive. You need to focus on attracting long-term tenants who ideally treat the house as if they were future homeowners themselves. Tenants who value the house, take pride in it, rather than constantly trying to exploit the lease or cause problems.
And that starts way at the beginning with rigorous, structured screening to save time and headaches later.
Pre-screening is paramount, absolutely essential. You must state your qualification standards clearly upfront, things like minimum income requirements, credit score thresholds, smoking policy, pet policy, before you even accept a full application and the fee.
Why before?
Because this allows potentially ineligible tenants to self-select out immediately. It saves you, the landlord, a ton of time and processing fees, vetting people who are never going to qualify anyway.
Smart. And then, even with an application in hand, never rely solely on what they wrote down. Verification is crucial. What are the key red flags and necessary checks investors absolutely must perform?
You have to check for legitimacy across the board. Verify their employment and income, get pay stubs, call the employer if necessary. Crucially, run a comprehensive eviction search through a specialized service, not just asking them if they've been evicted. Applicants often strategically omit previous rental addresses where they had problems.
That's icky. What else?
Check for unlisted occupants, people living there who aren't on the lease, or hidden pets, which are common rule violations that can cause damage.
Right.
And finally, establish a rigid communication protocol. Use certified letters for all important legal notices, like lease violations or notices to vacate, and meticulously document every single email and text message exchange in the tenant file. Create an airtight paper trail. It protects you if things go sour.
Documentation is key. Okay, finally, let's turn briefly to the digital transformation that's sweeping this industry. Prop tech. Its impact on transparency and efficiency.
Yeah, PropTech, it's really just the digital transformation of the built environment applying technology to real estate processes. Well, this shift is being driven partly by necessity. We're dealing with a massive and projected significant growth in global data volume related to properties, markets, everything. That demands robust data storage and, more importantly, intelligent analysis tools to make sense of it all.
And the application of these digital tools brings, two major benefits that directly address investor anxiety?
Primarily two, yes. First is transparency. Digital tools are definitely increasing market transparency. They give all stakeholders, investors, brokers, property managers, lenders, access to, as one source put it, robust, detailed, and reliable intelligence on diverse data points.
Right.
Comparable sales, rental rates, operating expenditures, market trends. This comprehensive data reduces informational asymmetry, the information gap between parties, and therefore it should reduce anxiety.
Okay, transparency is one. What's the second?
Second is environmental efficiency, surprisingly. Digital tools can actually reduce the need for physical inspections and property viewings. Think virtual tours, remote monitoring.
Fewer car trips.
Exactly. Estimates cited in one source suggest this could result in the avoidance of approximately 11.6 million miles of commute related to property viewings and inspections. That's a massive gain in efficiency and, of course, a reduction in carbon emissions.
That focus on efficiency and data intelligence leads us perfectly to the next critical layer of success. Because even with the best data, the deal still often hinges on the human elements, soft skills.
Right. We've established the financial formulas, the operational checklists, but professional success in real estate, maybe more than many fields, depends heavily on influence and often high-stakes negotiation.
Yeah.
You could have the best property analysis, the best deal structure, but if you can't effectively negotiate the terms, it might not matter.
And modern sales philosophy, as taught today, has dramatically shifted away from that old-school, high-pressure focus on the hard sell.
Definitely.
We're told the most critical step is no longer the closing. It's the connection, that initial phase of the interaction, building rapport.
This is driven by what is often termed the ninja mindset in some sales training, which sounds a bit silly, but the principle is sound. Serve, don't sell.
Okay, what does that mean in practice?
It means genuinely prioritizing the client's interests first, understanding their needs, their problems. This builds trust and rapport, which ideally leads to a natural conclusion, a sale or agreement, rather than a forced one. The goal is to be perceived as a trusted advisor, not just a transactional agent pushing for a commission.
Makes sense. And successful negotiation, particularly in complex situations where emotions might be running high, like, say, a foreclosure negotiation or a contentious commercial lease renewal, often relies on subtle conversational techniques to elicit information and build that connection.
Absolutely. One of the most powerful techniques discussed in negotiation literature is mirroring.
Mirroring, how does that work?
It's simple but effective. You just repeat the last 1 to 3 critical words the other person said, but deliver it with a genuinely inquisitive upward tone.
Okay, give me an example.
If the seller says, the price is firm because the appraisal came in low, you simply pause, lean in slightly, and repeat, the appraisal came in low.
It's not really a question. It's more like an invitation for them to keep talking.
Exactly. It facilitates bonding because it subtly signals similarity and active listening. And it encourages them to reveal more of their underlying motivations, their constraints, their strategy, often without even realizing they're doing so. It keeps the information flowing towards you.
Fascinating. Okay, so mirroring keeps them talking. But the ultimate goal in a high-stakes negotiation isn't necessarily just getting them to agree with a simple, maybe weak yes.
Right. A yes can be meaningless sometimes. It can just be a way to get you to stop talking, a simple agreement to move the conversation along without real commitment.
So what should the negotiator be aiming for instead of just yes?
You are aiming to trigger a "that's right" from the other side.
That's right. Why is that specific phrase so important?
Because "that's right" signals true mutual understanding and acceptance. It means you have accurately summarized their position, their feelings, their perspective. When the counterpart says, "that's right, you understand," they feel genuinely heard and validated. And at that moment, you have gained a powerful point of psychological leverage because you've accurately framed their reality back to them. Getting their reality confirmed is a far stronger psychological anchor for moving forward than simply obtaining transactional consent, like a weak yes.
Subtle but powerful. Beyond specific dialogue techniques like mirroring, broader psychological principles of compliance are always at play in real estate sales and even in how agents are trained.
Oh, definitely. Our sources confirm that compliance tactics and sales training often explicitly leverage the power of perceived similarity and, yes, physical attractiveness.
Really? Similarity and attractiveness?
Yes. People are naturally drawn to and more likely to comply with requests from those they perceive as similar to themselves, whether it's in background, dress, language, stated values, finding common ground works.
Okay, similarity makes sense. What about attractiveness?
And furthermore, research consistently shows that physical attractiveness tends to boost persuasion power. It's perhaps uncomfortable, but it reinforces the idea that image and presentation are critical components of the soft skills arsenal in client-facing roles.
Interesting. Okay, now let's talk about the foundation of professional excellence itself, regardless of the field. Habits. It's not about making massive, sudden changes, but consistent, incremental actions that ultimately shape who you become, your identity.
That is the core message of lasting success in almost any endeavor. Habits determine identity. As one author puts it, every action you take is essentially a vote for the type of person you wish to become.
A vote. How so?
If you consistently review 3 potential deals every single morning, even for just 15 minutes, you are casting a vote for the identity of an active, disciplined deal maker. If you consistently skip your follow-up calls, you're casting a vote for a different identity. These small votes accumulate.
And once initiated, habits gain momentum because they function like an entrance ramp to a highway. What does that mean?
It means that once you start a specific habitual task, it naturally tends to lead to subsequent, often related choices that you make almost without conscious thinking.
Like a chain reaction.
Sort of. For example, just opening your CRM, customer relationship management software, to log one call might often lead you almost automatically to check on three other leads while you're in there. The hardest part is often just starting. So the goal is to make the start of the process, that entrance ramp, as easy and frictionless as possible to leverage that momentum.
Okay. For those listeners struggling to adopt new productive habits, say getting into the routine of rigorous lead generation or consistent market analysis, the complexity or size of the task can be the biggest barrier. It feels overwhelming.
Absolutely. And the solution proposed is the powerful, deceptively simple 2-minute rule.
Per-minute rule.
Downscale any new habit you want to build until it can be done in 2 minutes or less. The initial goal is not perfection or completion, it's purely consistency, just showing up.
So instead of analyze a new deal for an hour.
Exactly. Instead of setting a habit goal to write a full financial report, you set the initial goal to simply open the spreadsheet template and write today's date. That takes less than 2 minutes.
Okay.
You must standardize the behavior first. Master the habit of showing up consistently before you can worry about optimizing its output or duration. Start tiny.
That makes it much less intimidating. And once that consistency is established, maybe technology can be employed to make compliance almost effortless.
This is automating your habits. It involved investing in technology, systems, or even one-time purchases that effectively lock in future desired behavior.
Examples.
This might mean using automated software to track leads and send follow-up reminders. Setting up automatic monthly transfers of investment capital into a specific fund. Using smart home technology to automatically adjust thermostats for utility efficiency in a rental.
So you take the decision-making and willpower out of it.
Exactly. Automating these tasks removes the need for conscious motivation or remembering to do it down the road. It makes future behavior almost guaranteed, freeing up your mental energy for higher-level tasks.
Okay. Finally, let's zoom way out to the broader context of land use and the city itself. Our sources highlight a truly unique regulatory reality in the U.S. that profoundly shapes the very landscape real estate professionals operate within: restrictive zoning.
This is often overlooked in day-to-day deal-making, but it's fundamental. The U.S. approach to zoning is unique among industrialized nations, primarily because of the widespread use of single-family residential-only zoning districts.
Meaning large areas where you can only build detached single-family homes, nothing else.
Precisely. This rigid separation of uses, mandating low density and homogeneity, is simply not the standard model elsewhere in the developed world. In Paris, for example, the largest planning zone, the general urban zone, permits mixed use by default. It encourages commerce, apartments, and single homes to coexist naturally.
That American segregation of housing types, keeping homes separate from shops, from offices, it has a deep historical relationship with how our cities grew outward, accelerating suburbanization.
Absolutely. Suburban growth really began with horsecar and then electric streetcar lines, which facilitated commuting from residential areas to downtown jobs. But the true decentralization explosion came with the mass adoption of the automobile.
Right. Cars changed everything.
They really did. This led directly to job decentralization as well. Companies moved out to the suburbs too. By 1970, the trend was so pronounced in major metro areas like New York that something like 78% of suburban residents also worked in the suburbs.
Wow, creating these self-contained suburban areas.
Right, leading to a degree of economic autonomy from the older, dense downtown cores. This, combined with that low-density single-use zoning, really locks in car dependence and significantly limits the variety and quantity of housing stock we can build.
This planning model, however, the sources argue, has a distinct pathology, especially when neighborhoods are built very quickly, all at once, without the organic diversity that allows them to adapt over time.
This takes us back to the insights of the great urbanist Jane Jacobs.
Right.
She spoke eloquently about the dangers of neighborhoods built all at once, which lack diversity of building age, building type, and, critically, diversity of uses.
Why is that lack of diversity dangerous?
Because these homogeneous areas, often dictated by strict zoning, lack the necessary fluid uses and the natural mixing of paths between different kinds of people doing different kinds of things at different times of day. This lack of spontaneous interaction, she argued, leads to stagnation.
Stagnation, how?
They show an inability to update itself, enliven itself, repair itself organically over time. They become brittle, unable to adapt easily to economic shocks or changing social needs.
So, successful, resilient neighborhoods, the kind that hold value long-term, require urban design that actively encourages that fluidity and mixing of uses and people.
Precisely. The example given of Rockefeller Center in Manhattan is key here.
Okay.
It occupies three long, large city blocks. It could have just been dense, forbidding office towers, but the crucial addition was Rockefeller Plaza, essentially an extra street, a pedestrianized corridor running through the middle.
Ah, the sunken plaza, the skating rink area.
Exactly. That design choice creates tremendous fluidity of use and mixing of paths, office workers, tourists, shoppers, diners. It turns what could have been a monolithic block into a highly successful, beloved, and resilient public center.
So it proves it's the fluidity and the mixing of purposes, not necessarily homogeneous architecture or restrictive zoning, that ties successful city neighborhoods together and helps maintain long-term property value.
It's a powerful reminder that the ultimate foundation of a property's value often starts not just with its current cash flow or condition, but with the regulatory context and the urban design choices made sometimes decades ago.
It really is fascinating. So wrapping this up, what's striking is how the fundamentals seem to persist. Things like finance, recognizing the value premium, rigorously adhering to dollar cost averaging, those remain the core drivers of investment success.
Absolutely. And on the ground, basic operational excellence mastering, staging to sell space, thorough tenant screening, effective negotiation, those remain the constant critical hurdles you have to clear.
And technology, like prop tech.
Technology seems to be primarily increasing the efficiency and the transparency with which these timeless principles must be executed. It raises the bar, perhaps, but doesn't eliminate the need for the fundamentals.
So what does this all mean for you, the prepared learner listening today? Maybe the greatest leverage you have isn't just in finding the cleverest loan structure or adopting the absolute latest prop tech stack.
Probably not.
It's more likely in the time-tested ability to execute basic profitable strategies consistently. You still need to be the methodical value investor who uses leverage wisely, manages risk, and masters the crucial soft skills of influence and negotiation.
Indeed. And for those operating in this space, perhaps it prompts a challenging final thought for you to consider. If technology, maybe even AI eventually, can increasingly automate the routine tasks we discussed, the complex valuation models, drafting the digital marketing copy, maybe even tracking your habits for you.
Right, if the machines handle the rote stuff.
Where must human expertise focus to maintain a true competitive edge? Is it in mastering the nuance and psychology of high-stakes negotiation? Is it in forging unique strategic partnerships? Or perhaps it's in deeply understanding and navigating the ever-changing, often quirky, regulatory and urban context of the specific American city or town you operate in? Where does the human element add the most value going forward?